As Tia sir mentioned, just giving you kind of a quick context. So I'm the chair of the sustainability track of TIE, and we are a kind of small cohort of people who organize various sessions to build awareness as well as drive some of the climate initiatives and kind of having some kind of stakeholder participations around various topics. For the annual forum, we have a very interesting set of panels lined up, starting with this climate risk session. Then we have a very interesting panel on water, a topic very close to my heart. And then third is on the deconstruction, means on the construction sector and how do you kind of decarbonize that space. And then in the afternoon, we have a lot of sessions around agri-tech and also the linkage with climate change. So coming back to this very interesting session, and I don't know some of you who may have attended yesterday, we had a good kind of keynote from Nobel laureate David Schimmel, where he articulated how do you really assess and manage climate risk. So given climate change is a kind of a very huge problem, and we are already seeing its effects, be it through floods, droughts, etc. So the focus has been on mitigation and you can how do you reduce GHG, but it is equally important, especially in the context of India or other emerging markets, to look into adaptation as well as on resilience to really kind of reduce the losses. What is not easy because of various factors around lack of comprehensive data, kind of quality of the information, what are the right kind of business models, and especially around how do you really kind of identify the local context and how do you really develop adaptation technologies and solutions that are relevant for the local communities. So with that in mind, we have a very excellent panel comprising a range of stakeholders across the ecosystem. We have somebody from the insurance company, Vineet, we have the startups, and as well as we have an investor on board who can give us a quick kind of snapshot as to what are the trends that she sees in the industry. So how do you want to structure is we will have a quick intro of each of the panelists. Then we will have around 30 minutes of question and answers, and then we will have some time for Q&A at the last. So without further ado, I will just request the panelists to kind of give maybe an intro, maybe like starting with Shreya as a maybe just kind of saying like who you are, what you do, and how does it link with this topic. Thank you.
Yeah, thank you so much, Suvranil and the Matrix Forum and TIE for organizing this. I am Shreya Bakliwal, and I am building an early stage investment firm called Aureolis Ventures. It's based out of Bombay, but I'm based in Bangalore. We invest in both India and the US, and one of our core focus areas is climate tech. You know, when Suvranil reached out, I got really excited about this topic overall because I have been an investment banker before. I was at UBS here in India and then later moved to New York. I've built companies in education and women's health. So both are some topics that require a strong behavioral change, and so is climate. Now I'm investing out of Aureolis Ventures. So excited to be here and share whatever I've been able to understand over the course of both my investments and a lot of thesis building. Thanks.
My name is Vineet Kumar, and my role at Swiss Re is I'm the head of the catastrophe piles for APAC region. For Swiss Re, if you look at what is our vision, it's we want to make the world more resilient and also make the world more climate resilient, right? And risk is our core business, and in my department, my team is responsible for developing climate risk tool, right? If you think about Japan typhoon or India flood, those are the things we do here based in Bangalore. And this is a topic very close to our heart, and that's, I'm here. So thanks for the invite and looking forward for a engageful discussion.
Thank you. My name is Ankit. I'm the co-founder and CEO of StepChange. StepChange was started with the mission of helping enterprises, financial institutions transition to net zero. And we all, I'm sure, understand net zero, and the world needs to get net zero. And I think the lead has to be taken by large enterprises which have the understanding and the budgets to actually start on that journey. The way we do it is by building what we call climate decision-making tools. tools. And the idea there is that every decision a company takes, what product to build, what vendor to use, who to give a loan to, not give a loan to, how do you think about the climate consequences of that decision before you take that decision, right? So how do you start changing behavior at an individual decision maker level? And that's the type of tools we've been building. Of course, we have stuff like overall ESG management, measuring things like scope 3 emissions and financed emissions. And we work a lot with banks where things like financed emissions and climate risk are starting to become parts of decisions they take at a portfolio level and even at a loan level. So we'll talk a little bit more about that.
Hi, I'm Samuel, and I'm the co-founder of Misteo. We are a climate analytics company, and we work at the intersection of finance and mitigation strategies. There are two main areas of focus for us. One is risk transfer, the other is risk avoidance, and we build, as you had said, tools that enable decision makers to create this intelligence. We call it climate decision intelligence, by the way, particularly in the agriculture and livestock sector. I'd be very happy to expand a bit more about our thesis as we go through the session. Thank you.
Thank you so much to everybody. So maybe I will just start with Vineet first. Now you kind of gave a kind of quick overview, but would like to kind of know a bit more details as to why climate risk is so important for the insurance industry. So I was reading some data from your Swiss Re report that around 18% of the global GDP will be affected due to kind of climate change. So can you just kind of give us a kind of overview as to why this is so important and what are the challenges as well as opportunities that you see in this space?
There are multiple questions. So, so if you look at Swiss Re or for insurance industry in general, right? And we have been, what we do, we take the risk, right? And so if you take a very simple example, if you buy a flood policy, right? So what we are doing is we are insuring, or insurance company, they are insuring it for the flood risk in exchange of a premium. And if you take the nature of the climate risk, unlike fire or motor, they don't happen kind of in a gradual manner, right? You could have many years where you have moderate events and suddenly you have a big event. So if you look at 2020 globally, Hurricane Ian that hit US, Florida, that has caused about $100 billion of economic losses. So it's the volatility of that risk. Yeah, that's very critical. So if you look at from the Swiss Re perspective or insurance perspective, so we have one is we insure kind of all kind of assets and business income for all complex climate perils. So we need to understand what is the risk. So we need to put a price around that one, right? So that we can charge a premium. And second, we need to also understand what could be a potential risk so that the promise we have given to the policy holder, if a big event will happen, we could pay it. So we need to know, okay, could we have a $10 billion or $50 billion of losses? So that's very, very important from our business perspective. To know or assess the climate risk and how also understand how there's a trend, if there's a trend around that one. But also if you think about insurance, they have a large investment portfolio as well from the income premium that we got from our operation. And those could be also exposed to mid to long-term climate risk, and that's also we need to monitor it. So that's why it's very, very important. It's very fundamental to our business. So maybe that's the first part of your question. Second, you asked what are the challenges in managing the climate risk. So maybe also I would like to distinguish climate risk from the climate change. When you think about the climate risk, and you mentioned about a report where Swiss Re published in 2021, economics of climate change. So climate risk is a function of, yes, climate, but it is also about the exposure, right? Assets, and they are also changing over the time, and also they are becoming more concentrated. So Bangalore is a kind of one of the example here. So those are also very important factor to kind of we have to be mindful when we are seeing a lot of disaster and the economic losses are increasing. Yes, climate change is playing a role there, but the dominant factors are those exposure change and how the concentration and more people are moving in areas which are more prone to climate risk. So I think in terms of the challenges, if you look at the nature of the climate risk, it's very localized, right? If you look at the flood, I think we had the flood last year. Yamloor could have very different flood risk than kind of a electronic city because it's very localized. So you need to know granular information. If I focus on the physical risk part, there is the other part of you could have a data challenges on the reporting side, but let me focus on the physical side of that one. So if you don't have that information, you can't assess the risk. And also the quality of the information. When you look at the climate risk, different kind of assets, if it's a wind turbine, right, new risks which are coming, they will respond very differently than regular building. This is a concrete building. They will respond it. If you don't have that kind of information, then you can't assess the risk. You can't assess the risk, then you can't put a price. If you can't put a price, we have an investor. You can't attract the capital because they need a confidence. Okay, could we assess the risk? Do we have a handle? Then they could put the capital there. So one is around the data side. And maybe other thing I would like to mention, I think this year earlier, I had a short rotation. Swiss Re has a unit, alternative capital partner, where we, for the climate risk, one is kind of we get insurance through regular insurance and reinsurance company, but also there's a lot of capital in the financial market, right? I don't know you heard of the catastrophe bond, right? Which are quite common in the US and also part of Japan. And I think there's a lot of appetite. People would like to invest in catastrophe business. And I think what are their requirement investors? They want transparency, or they want data is very reliable. And so that's why many of those products are in the US because they are reporting agencies. So if you know USGS or National Hurricane Center, if a hurricane comes, information would be available, it would be reliable, then investor could develop a product, okay, if a hurricane of this strength would hit New York City, I'm going to pay this much amount of money, and you could get money within a few days in your account. So I'm just trying to emphasize kind of data is very, very fundamental. Without data, you don't have a risk assessment. Without risk assessment, you don't have a solutions there. So those are some of the challenges I'm talking about it. But also, maybe on the data side, I think there's a good, I'm optimistic as well, right, with technology, right? So if you look at the regular insurance policy in the US, you buy insurance policy, you have to fill all kind of details, which is not always pleasant to fill it. And you buy it, and maybe you may not know, right, whether your house is covered by the flood or not. You never read it. And maybe there's a disaster happen, you have losses, then they say claims adjuster will come, maybe 2 or 3 times. There's a cost involved in that assessment. So what I'm trying to emphasize, it becomes a expensive process there. And those products may not be relevant for India or Malaysia, and where the technology could help us, right? Where I just want to give an example, kind of we had discussion with the Nagaland government. I think we had this product. Nagaland, I think, is exposed to mountainous region, to regular flood government, and where we have partnered with Tata AIG and Nagaland government to build this parametric product. And I think beauty of this product is it's just based on the satellite. If the rainfall exceeds certain amount in certain number of days, and government will get that money, and they could use it for the emergency purpose. So I think there's also kind of opportunity with the data. You could use these things, and they are becoming cheaper. I'm kind of 10 years ago, getting those satellite data, kind of it was more expensive. There's more kind of publicly available there, as well as building attributes through the satellite. You could get that information. So their side, I think there are opportunity from the data side as well.
Right. Thank you, Vineet. I think that was quite kind of elaborative. So Shreya, maybe just coming to you, and kind of, please kind of give us kind of an overview of the trends that you are seeing in the climate risk space, the various technologies, the business models, and what kind of startups are you seeing across the value chain?
Yeah, I think before I comment on the kind of technologies and startups that we are seeing, I think it's more important to understand the nature of these financial institutions. So if you look at banks, insurance companies, asset managers, they are both regulated And secondly, they also work on a portfolio approach. So if you look at banks, they have a portfolio of customers, right? They could be retail customers, corporate customers. For insurance companies, there is a portfolio of assets that they underwrite. Similarly, for asset managers, there is a portfolio of assets that they underwrite. So in that respect, data is very, very important. I mean, if you look at all the regulations that are in place, not only in India, but also across the EU and the US, where they are becoming more stringent, obviously, it would make sense to start measuring and reporting some of these data points that we have not historically done. Maybe we have, but not to the extent that is important, both from a reporting standpoint and more importantly from the standpoint of making sure that we are doing right by climate. So there we are seeing a bunch of companies that are, these are horizontal companies in the sense that these are companies that help you both measure and report your carbon emissions across sectors. So they are not specific to financial institutions, but more horizontal that serve financial institutions as one of their clienteles. So there is in fact a company called Watershed that is in the space. In fact, it's valued about $1 billion and it's based in the US. We are also seeing similar companies, and in fact, Ankit's company is an interesting one that could help some of these financial institutions help measure and report. The other thing that we've been seeing is, for asset managers in specific. Now, this is not something that is directly mentioned anywhere, but if you look at, asset managers such as Apollo, or if you look at Blackstone, these companies really have, like a large majority of their portfolio is actually concentrated into real estate and infrastructure, right? Brookfield, for example, large majority. And these are great emitters, right? But a startup called Acacia actually helps in the same thing, measuring and reporting of scope 1, 2, 3 emissions for, infrastructure and real estate. So in fact, they have an interesting GTM also where they actually reach out to asset managers and help all their portfolio companies. So we are seeing those indirect, I would say, models as well. Then the third thing that we have been seeing is that if you look at, just take an example of a venture fund, maybe like a consumer brand venture fund, right? Now for consumer brands as well, there will be emissions for sure. But for asset managers or the venture capital company, it is important to report what is going on. But beyond reporting, how are you taking steps to really make sure that there are lower emissions? So these asset managers are also working with consumer brand companies, for example, into their portfolio to help, regulate their supply chain in some sense, right? So for example, there are startups that are, I don't know if you, the beads that you see in your face washes, right? They are actually made of microplastics. So if you're able to get some vegan element, or vegan raw material that could be put into that face wash. So some of these alt material companies are also coming up that are actually helping with necessary actions. Because I think beyond measuring and reporting, actions also need to be taken. And yeah, we were seeing interesting models in both India and the US. Altem is one of the companies that is working on the alt materials piece. And interestingly so, because it's an Indian company with Indian founders and doing some interesting deep tech work, which again is great for the country. So yeah.
Thank you, Shreya. Thank you. Yes, now we're coming back to kind of Ankit. So I know that you have been really working with very kind of financial clients, and I was also reading that one of your blogs which states that the goods and services financed by the scheduled commercial banks contribute to 15% of the India's GHGs. So can you just unpack these finance emissions for us? And like, what is the real business case for financiers? Now, Shreya mentioned that there is, of course, there is a need, but still like balancing between profitability and addressing climate risk? Like where do you, and then where does StepChange kind of address this? Yeah.
Sure. So I would say that 15% was actually a very, very conservative number because we didn't want to put something out there that people felt they needed to challenge. But if you think about it, in India, for example, 30% of our emissions are power, 20% is industry, right? 20% is agriculture, and then waste and so on. Like every power sector is going to have a loan from somebody, right? Most industries are going to take loans from one of the. So at a minimum, you can influence 50% of India's emissions by influencing banks who are giving loans to those companies. Right? So 15% may be the direct sort of calculated value, but the influence is not 15%. The influence is actually much, much larger. And if you start including agri loans, etc., right, I think a vast majority of any country, not just India, can be influenced by influencing banks. Because banks are one of those places where you can make being sustainable being profitable. Because the moment they can start changing cost of capital for sustainable companies, for sustainable users, it is no longer a good to have. Right? As a company, if I'm more sustainable and I can get lower cost of capital because the banks are willing to take that into consideration, that's a huge carrot for an economy in general. And so that's sort of the thinking why financed emissions become important. So specifically what financed emissions means is when you, in carbon accounting, debt and equity are treated equally. Right? So let's say I'm a company, I'm worth, my enterprise value is 500 crores. I've taken a 100 crore loan from a bank. Then 20% of my emissions as a company becomes bank's emissions. Right? So you treat debt equity equally. So a certain percentage gets attributed to the bank that has lent you that money. Right? So that's how you look at every loan that every bank in India has given to individuals, to farmers, to SMEs, to corporates, to vehicles, and you look at all that, you sum all that up, and then you get the financed emissions of a bank. When a bank has to get to net zero, right, and of course everyone has to get to net zero in the next 30 years, but the people taking lead, so in fact if you look at globally, banks have taken lead in setting net zero targets. India is honestly just getting started, but when banks take net zero targets, it means their entire portfolio has to get to net zero. Right? Which means every loan that they give has to get to net zero, which really just means that the economy has to get to net zero. So banks calculate financed emissions. It's a fairly complex exercise in itself, and honestly, we are just getting started with this in India because data is a challenge. But once you calculate that, you start to make sense of where most of my emissions are coming from. Am I overexposed to the iron and steel sector or the cement sector, or is SMEs driving it, or is it my financing of diesel vehicles that's responsible? Where is this really coming from? And how do I transition in each of those sectors? In certain sectors, you might say, hey, I'm going to start pulling out slowly. In others, you might say, hey, I will work with my customers to help them get to net zero. Right? Third, you might say, hey, I don't have a capability as a bank to tell my customers how to go. I will just make it a requirement for them to do so if they have to keep getting lending. So every sector will need a different strategy. Right? And then within that sector, you will have to go and look, okay, let's say now iron and steel is too big for banks to step out. Right? Like there's a lot of industry in iron and steel in India. So if you have to take lead and reduce financed emissions, how do you pick the people within iron and steel who are being more sustainable? Right? Now, for example, Tata Steel recently announced that they're going to use green hydrogen to start experimenting with, right? So you might start picking those types of players rather than folks who are not even thinking in that direction. Right? So that's how broadly financed emissions are starting. The reason, the question was why, right? Why, what's the business model? So the business model comes from 2-3 places. One, if you're really taking a 20-30 year view, right? And banks are one of those institutions who take a long-term view of their business, and you know you have to get to net zero, right? And it takes years to build capabilities in-house, right? So you want to start today, so at least in 2 years, 3 years, 5 years from now, you have enough data, you have enough, the right credit policies in place to start making that transition. Second, RBI is actually making a strong push for this, and banks know that if you're not compliant with what RBI is asking, they come out quite hard. It's a compliance issue. The third is it's coming from a risk angle, right? So one of our main customers in any bank is often the CRO. It was starting to think about it from an investor standpoint. And the fourth place that they think about it is their own cost of capital, their ability to raise cheaper capital globally through DFIs, etc. Because green capital is increasingly coming at a lower cost of capital. Right? So there are multiple sort of stakeholders, multiple reasons, and different banks do it for different reasons. Right? Some of our larger banks have a lot of FIIs. Right? They are pushing them to start moving faster. So it's a mixed bag at the moment, honestly. But I think everyone realizes this is happening. They have to start doing it. And so I think that's where they are.
Thanks, Ankit. Now, Samuel, so I know that you have a very kind of interesting perspective of not only looking at like directly into the climate risk, but having like a one step above, in like looking into like broadly, having like a holistic approach. So if you can just kindly allude to that. And then I was quite intrigued by your work with the small landholder farmers in the agri-insurance space. So it would be good to get to know some kind of perspective and some examples. Sure. Thank you.
Sure. As I spoke about in my introduction, there are two main areas of thrust for us. One is definitely the risk transfer side, which we all know. It's basically get yourself insured and everything will be all right. The other part is the risk avoidance, which is basically investments that go into how we can avoid a specific scenario, which alludes back to what Ankit has talked about in terms of bank lending. What we are seeing is within that lending, we are looking at priority lending sector, and within the priority lending sector, what we are seeing is in terms of how these lending instruments or the financial instruments contribute to climate friendly approach. So this is broadly the area that we essentially work in. Now, a bit more on this entire climate change part. Yes, we are all talking about climate change. We are talking about money as one of the key, input drivers that go into it. But what we want to do is we want to think it from a planetary crisis kind of a perspective. Just to note the point, I mean, you've seen what's happening in the US in the past couple of days. Wildfires in Canada is affecting lives in the US. The Canadian Prime Minister booed off the stage because he wants voluntary contributions to stop the wildfires. So there's a lot of these very interesting areas of existence that we need to look at and how we can essentially push that investments into that perspective. Now, I'll bring that that context because those are the risk drivers for us. So what what is happening for what Vineet is doing in Swiss Re is reducing the spatial basis risk in terms of understanding what is the most what is the most accurate, reliable data, how we can build that accurate, reliable data where the data doesn't exist. At the same time, bringing that across through to insurance, reinsurance companies and banks to basically come back and say, okay, you know what, this data is analyzed, this data is reliable, and therefore we are going to build products and solutions around it. So that is one of the demand drivers for us, where we are working on increasing the increasing the data reliability, and wherein two of the main areas of focus for us, where we work, we are doing that. So one is the small landholder work that we do here in India, where we have deployed an entire end-to-end system that includes in situ monitoring as well as numerical weather predictions, and of course building the entire risk transfer end-to-end settlement platform that enables the farmers to get money on time. The other one is very interesting is because we are working in a sector that has a very large carbon impact, which is the livestock sector. As you very well know, methane emissions is 20 times every ton of methane is 20x in terms of carbon emissions. So completely underappreciated, where we are helping the livestock owners in various parts of the world. Primarily, the work that we are doing in Australia is to provide them with two things. One, providing the early warning system to tell them that your livestock is having a problem. The moment you have heat stress impact, panting scores go up. The moment panting scores go up, the emissions increase on one part, and on the other part, a cattle that is worth about 25,000 Australian dollars will suddenly fall sick and die. So what we do is the early warning system, and then back linkages to that is working with the banks and the insurance companies to basically do the risk transfer. That's all well and good, but the way we are going right now, there won't be any risk that we can insure anymore if we do not really look into it, and that's where the risk avoidance comes into place. And that's what I think, Shreya, you talked about, various companies that are actually working in the behavioral change side. So we have to look at it from that holistic perspective. We are doing a couple of very minor baby steps in the risk insurance, risk transfer and risk avoidance side, but I think much larger pieces, look at how the money is flowing into it, the end beneficiaries, how they're benefiting. Are we really focusing on risk transfer, or do we need to really put our money in risk avoidance? I think that would be the way, and that's our thought process, and we are doing it in that direction.
Thank you, Samuel. So we will just go maybe do a kind of quick one more round, and then I will request the audience to just think of any kind of questions that may have. So Vineet, coming back to you, and just to kind of give that global perspectives. Now we see that there is like every kind of insurance company is kind of focusing on this one. A lot of this alliances being formed, both kind of globally to address this risk. So can you just kind of give some examples where Swiss Re is involved, and what are the kind of key goals of such platforms beyond just like the talking, beyond the advocacy or say awareness building? What are the kind of real work being done by these various kind of multi-stakeholder platforms?
No, thanks. So Swiss Re has one particular department we call public sector solutions. I mean, when we're talking about the global alliances, but they work in each region. Like in India, they're talking to different departments, government, state governments, etc., and where they're trying to find a partnership, this public-private, because these are the problems, right? It's not just not only the insurance, right? I think you highlighted. There are other things that has to fall into the place as well. So that's happening throughout the world, right? So it's in Africa, it's in the US. So we have recently had a product for New York City for the flood, and I think just a few days ago we have a product for the Kenya for their farmers, and for India. So that's happening to real action. Definitely on the awareness, I think that has been a topic for Swiss Re. Probably the first one in the 70s we brought it up. But maybe the global alliances, I think, maybe I could mention about one more insurance related, one more kind of a broader kind of a topic. One is where Swiss Re is a co-chair. So this is World Economic Forum Climate Leaders. So this is a coalition of CEOs of large corporations who are committed to net zero by 2050, like a Swiss Re, right? We are committed to net zero by 2050 for our investment and our business, and in our operation, we are committed by 2030. So these are the other companies. These include companies like IKEA, H&M, Procter & Gamble, and many banks there. And there, the purpose of this coalition or the alliance is build a very influential network where we learn from each other. So some of those companies are far ahead, kind of they have a more understanding of their supply chain, kind of a emission, and so that we learn from each other, we set the standards, we could influence the policy maker, and also we bring them into our operation and set higher and higher standards. So it's very tangible kind of a impact in our value chain and in our market. So that's the one I would like to mention. Other more insurance side, which is maybe more related to my work, this is an insurance development forum. And I think it's a public-private partnership where insurance company, they would like to partner with the institution like World Bank and others to increase insurance take-up rate, because we know if there's a high insurance, societies recover much faster. That is at least one instrument. I mean, just taking example of India, I just wanted to highlight this insurance take-up rate. Right, in 2021, we have this Amphan cyclone hitting the right, and if you look at estimate of the economic losses, if you know in the media or others, it's $14 billion US, right? And I think most of those were in India. some in Bangladesh. And if you talk about the insurance losses out of that, how much? Of the order of 200 million. That's a kind of, so it's a gap is like in only 5% is insured. And yeah, it's gap is worldwide, even in the US, but it's much, much smaller. So I think this coalition, they are trying to find how we could increase this insurance take-up rate, how we could find, going back to the data, this risk analytics, they are available everywhere in the part of the world, because that's the foundation. So that's the another one where we are part of it.
Maybe, Ankit, to you, if you can ask, is, and you kind of mentioned that, but would like to kind of double down on, like what are the kind of core kind of challenges in terms of that data that we mentioned about not only quantity, but on the quality of data, that one needs to really kind of develop these robust models. And there is no kind of like a set kind of standards as to what is right, what is wrong, and sometimes it's all kind of based on the either the past estimates as well as for future projections. So what's your kind of conversation with the banks in terms of how they should kind of work or how they should engage to really kind of be able to kind of make the right decisions?
It's going to be hard to answer that in a few minutes. But let me start with this. First of all, there is no source of truth when it comes to a lot of environmental accounting. Right? Everything is modeled. Everything is an estimate. Right? Even the simplest thing of, okay, I've burned so much diesel, what are the emissions? It's a calculated number that someone did. It is not exactly what's happening here. Right? Unlike financial accounting, where you can look at the end of the year, cash in your bank balance and match it with your statements to say, okay, is this really what it is? There is, yeah, so that's where the problem starts. Right? So it in the end ends up becoming more accurate models versus less accurate models, where you don't know what accuracy means, right? Because there's no source of truth. Right? So it just becomes about, hey, is there a scientific reason or a statistical reason where you believe a certain model is more accurate than the other? Right? And oftentimes, more complex models are not necessarily more accurate, right? Because a complex model will take hundreds of inputs, which allows for hundreds of inaccuracies, right? So if you get it wrong, it increases the inaccuracy rather than reduces it. Right? So these are fundamental problems in this sort of environmental accounting space. Now, the way you sort of deal with it, in case of banks, there are global standards like PCAF, which say that for every type of loan category, there are 5 ratings of how you can go about measuring a loan's emissions. Starting with fairly high level, category level ways of doing it, and down to a company actually reporting their emissions and getting it audited. Right? The hope there is that, of course, the company is reporting correctly and the auditor is doing a good job. Right? But so there is a framework for how you go about it from very high level, category level, which is where a lot of banks in India are today. Right? The good thing is, at least in the financial industry, there's a lot of data. Right? There's a lot of data at a sector level. Every loan that you give out, you will ask for a bunch of things in India. Right? In India, in fact, you will ask for more data. You'll ask for all types of balance sheets, income statements. I'm talking more corporate and SMEs now. You will ask for inventory data and all that. Right? And all that is available in banks. It's just available in silos that don't necessarily talk to each other. Right? So the problem becomes more about integration, getting the data, scraping the data, and starting to make sense of it. The next step for banks, so one you can do at a sort of a sector level, which is high level, then you can go down to a loan level using whatever data the bank has. Right? And what we are trying to do as a startup is, hey, we'll meet you where you need to be met. How do we take accounting data, because financial accounting data is relatively reliable, and make that into carbon accounting data, right? And basically build a translation layer between the two. But then the next step, of course, is doing actual emissions accounting for every underlying asset, right? Which could be a vehicle, which could be a person, which could be a company. And that, of course, thankfully, starting this year, SEBI has mandated that top 1,000 companies in India have to report their ESG metrics in a lot of detail. So that will become a huge data set. Now, as many of those companies start doing scope 3 emissions, they are going to ask their suppliers to start measuring this, right? As banks start to think about doing this and make this part of their decision making, they are going to start doing this, right? So a lot more companies, we are hoping over the next 5 years, will start measuring this themselves. And then you'll basically have to create a layer between companies that are reporting this, and how do you get it to the bank for decision making. Yeah, so.
Thanks, Ankit. So, Samuel, we have not discussed the elephant in the room, which is the governments. I know that you have been working with the governments as well. So, can you kindly allude the role of governments in assessing and managing climate risk?
There are many elephants in the room, as a matter of fact, not just the governments. So just to give you an example, I mean, so we work with the government, and government, whenever we go to investors like Shreya, they just completely shy off from that because nobody wants to do government business. But unfortunately, so the risk of climate, the largest amount of it is carried by the government, so we cannot not work with them. That's as simple as that. So that is number one. Number two, are they acutely aware? Yes, they are. All of them are acutely aware. You would be surprised to know if you go and talk to them. They are very well thorough about what is the impact, what's the long-term impact. It's just that the frameworks do not exist as we speak for them to do it. Example is Nagaland. I mean, I'm very well aware of what you have done in Nagaland. It's been 3 years since that has happened. 2020, and we haven't seen anything beyond that. So that's number one. Then number two, the other part is in terms of when we, I mean, just to give you an example of how we worked. So when we started building these products, you know, they wanted us to do this amazing analysis and saying that, okay, we don't have data here, let's do it. We ran numerical weather prediction models. We came up with very good accuracies. We went back to a very specific reinsurance company, which I will not mention the name of. It's like, yeah, it's all well and good, but our data has to come from IMD. And that's where the conversation stopped, because you cannot go beyond that, you know, because we cannot blame them either, because, you know, they are extremely regulated. So these are the key challenges that exist in terms of the lack of framework to engage with, companies like us, engage with companies like what Ankit is doing to enable that process is one of the key biggest challenges. The next is the money part. So a climate problem has a climate time scale. It's a temporal time scale of 10 to 15 years. And no investor, for that matter, would want to see beyond 7 to 8 years. And if any investment thesis, let that be government, let that be investor that needs to come in, they need to understand that you are in it for the next 15 to 20 years, beyond which we are going to see a single pie that is coming out as profits. Maybe they will hit profits before that. But there is a silver lining. The silver lining is, I mean, you know, I guess, you know, Ankit, you can talk about it much more than I do. Have you heard of the green accounts that the banks are now allowed to start? So in the what do you call it, customer private lending space, the banks are now mandated that they can start what's called as a green savings account, which means that the banks can now raise money from from the customers, and they can then invest that into climate related what do you call it, entities and climate related work, which is a much step change. You know, what we've seen 3 years ago, this would not have happened, but now it has happened. So good things are happening. It's just the fact that we have to keep on top of them, and then we need to hit them where it matters the most. And then I guess ultimately the beneficiary is you, me, and everybody else. So we need to think in that direction. And cat bonds, there is another part that you guys have been talking about. So retailing cat bonds is going to be the next big thing. So you and me, we can invest in catastrophe elsewhere in the world. That would be gaming the system. Let's see how it goes.
So, Shreya, like coming to you, I think based on your kind of numerous interactions with kind of founders in your portfolio as well as kind of outside, like what are the kind of the key learnings? Like what worked, what did not work? What are the kind of I mean, I know we discussed the revenue model, but also we have a lot of like startups within the TIE network. So any advice for them who are kind of trying to build the next solution in the climate risk space?
Yeah, I think as all of my co-panelists talked about, right, there is so much of government involvement. There's so much of, the likes of Swiss Re, insurance companies in general, that are involved. And these are big organizations that not necessarily everyone understands. Big organizations with, too many divisions to tackle. So I think it's very important to identify what do you want to do, and who would be the right person, right POC, point of contact within each of these organizations. Because I've seen multiple times that, you know, founders get really excited that, hey, we've started a pilot with so-and-so company, but then the pilot sort of stalls. And so it's important to sort of know how the organization works. And it's not that they don't, I mean, these large organizations definitely want to work with you. But as you know, all of us discussed earlier, trust is important. And how do you build that trust? I think it's important to really understand the human, I mean, essentially incentives drive behavior, right? So really understand who are you talking to, what is the incentive, and how can you help? So sort of co-create some of these solutions that you're building with you know, the large organizations is really important. Then the third is honestly like choosing the right investors. I understand that the investment horizon that you talked about, usually 7 years, but there are other you know, institutions, even families that are willing to sort of give patient capital to some of the companies, right, that are building in climate change. So for example, climate tech rather. We invested in this company called Impossible Metals. It's based out of the US, and the idea is to you know, work in the area of deep seabed mining, but in a more sustainable manner. And to, I mean, it's a big thing, right? Because we all know that there will be supply chain issues. EVs, you know, we see EVs. Ankit just used an EV to get to the venue. And so we are really seeing EVs come up in a big manner, and supply chain is definitely going to be very critical. And you know, if metals, like how do you source these metals? And this, you know, right now we invested, say, a year and a half ago, and the company is working on its V3 of the first product, and the company has been around for 3.5 years, right? So the thing is that we all realize as investors in the cap table that it's going to take long, but is it something that we want to be part of? Definitely. And I think, you know, ultimately the business that you do is all human to human, right? And how you understand humans. So you'd need to find the right human beings and right investors to be able to grow your organization. So yeah, that's the learning that we've had so far. And yeah.